Good morning, it's Jeff Christian, CPM Group. It's just before noon on Tuesday, January 11th here in New York. I want to talk a little bit about what matters now to the markets for gold and silver. There is, as always, a lot of static and noise in the markets. These markets are, as we've said repeatedly, extremely asymmetrical. Some people know what's going on. A lot of people don't. The spread of information across the markets is very irregular and uneven. I'll talk about what really matters now. And I think primarily on an economic level, what matters most right now are interest rate patterns and what's going to be happening with interest rate patterns. Now, those, to some extent, are based on what's happening with inflation and with overall growth in the economy, both in the United States and on a global basis. But if we're, and people have asked us, well, what are you looking at, CPM Group, right now in terms of the market? And what we're looking at right now is, on an economic basis, interest rate patterns, inflation, the dollar, and equity markets. Because those are really four of the big areas that will help stimulate investment demand or discourage investment demand. Very strong stock market sometimes is good for gold because people get very nervous that it's high and it's going to fall 10%, 30%, 80%. Other times, and I think you're seeing this in the last couple of days, perhaps people say, hey, the stock market isn't going to collapse. It's been rolling along and it's probably going to go ahead along those lines. I'm not quite sure. Interest rates obviously have been very important, and we've made the point repeatedly. We've seen interest rates move sharply higher by current standards over the last 2 weeks. They're now about 1.78%, I believe, for the 10-year bond. Shorter term rates obviously are still somewhat lower. But you can see from the charts here that both on a nominal basis and on a real basis, interest rates are very low. And even if they double from where they are now, they'll still be very low. So we don't see interest rates particularly being a major break or headwind for higher gold prices. But they are something that people are paying attention to. They tie in closely with inflation concerns. And we have two events today and tomorrow that we're watching closely. One is there is testimony for Jerome Powell for his renomination on the Capitol Hill. And I am certain that he will be very forceful in his plan, in outlining how the Fed plans to control inflation, get inflation under control, and meet its obligations to try to match both full employment and stable prices in the United States. I also am certain that you'll have all kinds of really moronic rhetoric in questioning him by various people in Congress, because that's what Congress does. So I think you'll hear a lot of stupid things said on the part of Congress people, and I think that Jerome Powell will probably handle them with much more aplomb and acuity than I could possibly do. The other thing is that the CPI data for December comes out tomorrow. Now, a lot of people think it's going to be high. I tend to ignore those market projections that come from banks and brokerage houses and such. It's probably going to continue to show some problems. And one would think that high inflation issues could be positive for gold and silver, but our warning is that maybe they aren't. And that's because the markets may react to higher CPI figures and Jerome Powell's testimony and comments today and say the Fed is going to put the brake on inflation. They're going to fight inflation more forcefully. Interest rates will rise higher and sooner than we had thought. The withdrawal of monetary accommodation through quantitative easing will be faster and sooner than we had thought. And that could be negative for gold and silver. It could especially be negative for gold and silver, just on a short-term basis, the next day or two. Could be particularly negative if, as we've seen this morning, gold prices and silver prices have risen. Last week, CPM Group issued gold and silver trade recommendations, our short-term, 5 to 10 trading day outlook for gold and silver. Gold, I think, was probably around 1792 at the time. We said we thought it could go to 1800 initially this week, and possibly as high as 1810 or 1815. It hit 1810 this morning, and it's backed off a little bit. If it goes back up and it's in the 1810, 1850 range, and the CPI figures come out strongly, investors might say, oh, the Fed's going to jack up interest rates higher sooner than we thought, and you could see a short-term sell-off and profit-taking in silver and gold. The same is true in silver. Silver, I'm not sure where it was last week when we issued a buy recommendation, but we said that we thought it could go to 2250. Excuse me, sorry about that. We thought it could go to 2250. It got to 2270 something today. It's down to around 2250 the last I looked. And you could see that same sort of thing. So we're watching those inflation figures for tomorrow, and we're not quite sure how they'll be taken by the broader financial markets as well as precious metals investors. That's what we're looking at. The dollar, so that's interest rates, inflation. The dollar has not collapsed. It's held up pretty well. And you can see here the relationship between gold price increases and the dollar over the last 14, 15 years. Hasn't been particularly high. So gold prices have been rising even though the dollar hasn't particularly fallen. I mean, you saw a period of time where the gold price was rising along with the dollar falling. Then you saw them both, the dollar falling and gold prices rising. You saw the dollar rising and gold prices falling. But the correlation hasn't been particularly strong in the last year or two, and we don't expect it to be. On a fundamental side, I think the key things that we're looking at in gold is we're seeing signs of investment demand picking up across the spectrum of gold investors. So ETF investors, futures and options investors, and physical gold bullion and coin investors, we're seeing signs that, having seen something of a lull in investment demand for a few months there, it's starting to pick up. And central banks are pulling back a little bit on their purchases. They're still buying, but they're being a little bit more hesitant about it. So those are the things that we're looking at right now. I want to pull up this chart. This is the central bank's foreign exchange holdings. And you can see the gray area is US dollars. It's about 59.4% of total foreign exchange reserves held by central banks are in US dollars. And you can see it's relatively stable. There was a period of time, 1995 into 1999, when the dollar actually gained, and that was the run up into the euro. So those central banks that were going into the European central banking area, who had currencies of other central banks going into the euro, had to get rid of those reserves because as of January 1st, 1999, those currencies wouldn't exist anymore. So if I were the German central bank and I had a lot of French and Dutch and Italian and other European currencies, I had to get rid of those. So what am I going to do? Well, I'm going to sell them. I'm going to get US dollars for them. I'm going to hold US dollars. So you saw a period of time where the percentage of central bank reserve foreign exchange reserves held in dollars went from about 59% to about 70% in the run up to the euro, 1999. And then you saw it fall down, and it got down to about 60% within 12 years or so. And it's been 59, 60% pretty much since then. I bring this up because I saw one of these great things on the internet about how central banks are dumping the US dollar, and that US dollars as a percentage of foreign exchange reserves are at their lowest level in decades. I think they said half a century or something like that. No, it's not true. It's just not true. Yeah, I mean, you might as well be a politician if you're going to say stuff like that. It's not true. Don't worry about it. And don't think that you need to move into gold immediately because central banks are dumping the dollar. They're not. They're trying to diversify their foreign exchange holdings, but they're having a really tough time doing that because of the massive liquidity that exists in US dollars relative to the liquidity that's available in other currencies. And if you're trying to move a significant portion of your dollars into those other currencies quickly, you drive those currency values up and you actually cause inflationary pressures in those countries. So there is a long-term trend or desire to diversify foreign exchange holdings away from the dollar, but it hasn't been particularly successful over the last 40 years. And when I say 40 years, yeah, 40 years ago, we were talking to central bankers and they were talking about their desire to diversify away from the dollar. It is what it is. I want to talk a little bit about what CPM is. And I want to do that because people who don't know what they're talking about with gold and silver and platinum also don't know what they're talking about when they talk about CPM Group. CPM Group is me, and it's a whole lot of other people. I created CPM Group in 1986. Before that, I was running what was the J. Aron Research Department. J. Aron merged into Goldman Sachs in 1981, and I took over what became, well, I was still running what became the Commodities Research Group within the Goldman Sachs Investment Research Department. And I ran that until 1986. At that time, there were a variety of reasons why I wanted to leave Goldman Sachs and actually financial institutions in general. And I had the opportunity to buy the research department out of Goldman Sachs and set up CPM Group as an independent research company. We did that. And you can see here some of the reports. That blue report on the left is a J. Aron silver report from, I believe, 1980, 81. When Goldman took over, we went to that stuff in the middle called precious metals research. It's kind of green type on a light green paper, and we called them commodities market perspectives. I think we did 6 a year. When we left Goldman Sachs, we created the precious metals quarterlies, and we had precious metals gold, precious metals silver, precious metals platinum group metals on a quarterly basis. That's that silver report in the middle. In 1989, 1990, the Silver Institute hired us to make what became the World Silver Survey, which was a stripped down lay version of the much more intense reports that we were doing as our precious metals silver surveys. We did that for about 4 or 5 years. We were not comfortable working with the Silver Institute as it was constituted in the early 1990s. And so we stopped doing that. And we began accepting sponsorships for our quarterly silver, gold, and platinum reports. This was 1995, 1996. And then after, well, starting in 2006, we took what were our surveys and made them into yearbooks. And those books are there. This is our silver yearbook. And, I just tagged a couple things here. If you really want to know about silver mining reserves, on page 65 of this year's report, there is a table of new mines that have come on stream over the last few years, and there's 91 million ounces of reserves, not resources, but reserves in about 11 different mine deposits that are slated to come on stream sometime in the future. So there's a lot of information there. If you wanted to know about reserves and resources, there's all kinds of data there. And we have those kinds of reports for silver, platinum, and gold. There's a lot of information there. And as you can see, I took over the research operation in 1980 at J. Aron, but Aron actually started doing this in the late 60s. If you look at where the data comes from, and there was somebody who made a comment to one of our videos recently, CPM Group, where do they get their data? Well, we get our data from wherever we can. We collect data from all over, and we have since the late 60s, early 70s, and we continue to do that. Back in the period up to 1993, there were two groups that did that for silver. J. Aron, Goldman Sachs, CPM Group, and Handy and Harman, which was a refinery. And Handy did these little booklets over on the side. When they saw that we were no longer part of Goldman Sachs and that we were a stable, prosperous company that wasn't going to go away, Handy stopped producing its reports and gave us their files and their historic books. And we have been the source of data for gold, silver, platinum group metals, as well as a lot of other markets ever since. And you can see our data in our yearbook. You can see 200 pages, and that's the abbreviated version. We have long-term reports. We have our precious metals advisory. We produce estimates of how much silver is being mined, how much is being recovered from scrap, how much is being used in various industries in various countries, how much exists in inventories. There are other people who come close to doing this, but they tend to be affiliated with marketing groups, and they tend to get some of their data wrong. CPM Group, however, has been around, well, we've been around as CPM Group for 35 years, but we've been around as a research group going back to the 1960s. And we really study these things accurately and closely. In gold, there was Consolidated Goldfields, which was one of the world's largest mining companies up until the late 1980s. And they had a research department that actually worked with us in collaboration. We shared consultants in India, in central banking, and in parts of Europe and other parts of the world. And we worked, CPM Group, J. Aron, Goldman, CPM, worked in collaboration with the Consolidated Gold people, and those were the two companies that produced that gold data. When we merged with Goldman Sachs, I started reporting to the chief economist there, and he said, "How's your projections?" And I said, "What do you mean?" He goes, "Well, when the governments come out with the final data, how do your projections for supply and demand stack up with the final data?" As the governments don't come up with final data. There's nobody that comes up with final data other than us. So it's kind of like sitting on top of a rocket. You really don't have a lot of feedback. When Consgold was there, when Handy and Harman was there, we could bounce notes off of each other. And we did. Sometimes we would say, well, we think this gold is coming from a central bank. And they would say, Consgold would say, well, we think it's investors. And they would know, well, this is what we're seeing. And they'd say, well, this is what we're seeing. And we would try to come up with some sort of understanding of what we were receiving in extremely secretive, extremely asymmetrical markets. And that has been the case. When I came to Aron in 1980, I also started Platinum and Palladium books. And the book on the left here is the annual Platinum and Palladium review and outlook that we produced in May of 1981. And that a lot of people consider to be the first Platinum Group Metals market report that was ever published. And I think I've mentioned in past things, when we came out with that report, data on production in South Africa was still corporate secrets. And we had Rustenburg Platinum, which was the predecessor of Anglo Platinum, Impala Platinum, and the Soviet government all investigate where we got our numbers, which was the only way that we knew that we were anywhere near close in our estimates. We took our data back to 1976 for PGMs. That we started collecting the data and working on it in 1979. We took it back to 1976, 79. Before I started Aaron, I was working on PGMs in my previous job. And people will ask us, why is it that everybody's data starts in 1976 for platinum group metals? And it's because it all started with that report. And we still have people requesting it. The next report over is a long-term 10-year projection report that we did in 1998, 12 years after we had done it. And we started producing 10-year projections in the 1980s, gold, silver, platinum group metals, oil, natural gas, copper, and other metals and commodities. So we've been doing this not only with precious metals, but with energies and with other metals since the 1980s. And we've produced these 10-year projections. In 2017, because of issues in the PGM market, we took our 10-year projections and we took them out to 2050, which was 33 years, a third of a century at the time. Last Friday, we released our update of our long-term platinum group metals report. It's platinum, palladium, and rhodium, and the projections go out to 2050 because of the difficulty in assessing the implications for platinum group metals as well as other metals like manganese, lithium, cobalt that we do research on, of the technological changes that may come in automotive propulsion technology. Now, if you go all electric, you don't need PGMs cleaning up petroleum exhaust. But it's going to be decades if we go all electric, before we get there. And the IEA, the International Energy Agency, assumes that by 2050, oil, natural gas, and coal will still be the predominant sources of energy for the world in its most likely scenario. Not its objective to get to zero carbon emissions, but in its most likely scenario. It has more energy coming from petroleum products than all renewables combined by 2050. So that's still 28 years from now. So you're going to be using PGMs to clean exhaust for a long, long time. So that's what we are. From the time I worked at J. Aaron in 1980 until now, CPM Group staffing has varied between 3 or 4 people and 16 people. It goes back and forth. CPM Group is not me. I happen to be the spokesman and the largest shareholder, but that's who we are. It's a very large group of people who are seriously committed to trying to get the best data and estimates of supply and demand and price projections for precious metals and other commodities. And we are the source for basic data. So the WAG who made a comment on one of our videos well, where does CPM Group get its data? We get it from wherever we can. We collect data constantly and we look at it. I made a comment last year in one of my videos that the difference between an analyst and a demagogue is that an analyst will actually look at all the data and see what it tells the analyst about the market, where a demagogue picks the little pieces of data that supports their view. So they'll say, well, you look at the reserves of silver falling at major mining companies, and they don't look at the resources, and they don't look at the total industry reserves and resources. And they'll say, well, that mine used to have a higher ore grade in its reserves than it does now. And they don't bother to point out that, well, that's because back then they only mined what they could see. They didn't have the technological capacity to even determine that there was gold and silver in rock if you couldn't see it. much less to chemically and pyrometallurgically and hydrometallurgically recover that metal from that. And they'll talk about mines that have 10 years life, mine life of reserves, right? The Homestake mine was created, I believe, I want to say 1884 in South Dakota. It was closed in 2002, 2003 because of mismanagement. It still had reserves and resources, but the mine had been poorly managed, and so they shut it down. In that 130 years or 120 years span, it never had more than 10 years worth of reserves. And Yoles Fresnillo mine in Mexico started mining around 1564. It's still mining today. It's one of the biggest sources of current silver mine production, and it has never had more than 10 years worth of reserves. That's some of the data that's there. I'm not in the business of educating people who criticize me. I'm in the business of educating people who pay me to teach them about the market. We do make a lot of information free in these videos, and we will continue to do that. But if other people want to just go around spouting off about things they don't know, that's their prerogative. That's one of the glories of gold and silver and commodities in general, is that they are poorly regulated. People would land in jail for saying things about stocks or bonds that they say about gold and silver. I will end with a question to ponder, but before I do that, we're available. We provide real research, real analysis, and fact-based price projections. You can buy those yearbooks that I was showing you. We have gold, we have silver. The gold book has all sorts of stuff. There's also a lot of information about the costs, including breakdowns of costs between labor, chemicals, energy inputs, and other factors that come into the mining costs. Mining data is relatively easy to come by because the mining companies, generally speaking, are public. They have regulatory obligations to give you information, and they have an economic incentive to put out information to try to get investors to invest in their companies. Secondary refiners, people who recover precious metals from scrap, and that can account for 20, 30% of total newly refined supply in any given year. And fabricators have no regulatory obligation to divulge information, and they have an economic disincentive to be forthcoming with that information. So what you'll find is a lot of people who focus on mine supply because the data is relatively available, but they don't get the secondary recovery and the fabrication demand and the investment demand and the unreported inventories. We provide real research. We do have an open forum, which is for paying clients, including retail investors who buy our research and consulting. The next one will be Wednesday, February 23rd. And there's some more information about who we are and what we do, including research and consulting, and then specialized consulting like asset management, commodities management, and investment banking advisory services. I'll leave you with one question to ponder. I have a theory about it, and it's 5 steps away from gold and silver, but it's something to ponder. At the end of World War II, the world created the United Nations as a place where countries could come together and try to sort out problems rather than resort to war. We had gone through World War I and World War II, and the guys who were left standing said, hey, let's try to create a United Nations to avoid World War III. And it was at the time of the Cold War, so it made sense. And the United Nations has prevailed and kept several wars from occurring. It's been pretty good by providing peacekeepers around the world. The question to ponder is this: given the origins of the United Nations, given its success in reducing war and reducing warfare over the last 80 years, why is the United Nations not involved in resolving the Russian-Ukrainian border problem? I have a theory. I'm not going to share it with you. You can guess what it is if you understand what I've been saying on these videos for the last 2 years. But it's something worth pondering, because while it doesn't necessarily directly relate to gold and silver, it relates very much to gold and silver, because the fact that the UN is not there raises the stakes of that border problem and that border crisis. And that's one of the factors that investors are taking into consideration when they decide whether or not to buy more or less gold and silver. On that, have fun pondering that question. Don't bother posting your responses, keep them to yourselves. And we'll talk to you on Friday.